Hello, my name is Ethan Luft, and this is Investing in the Stock Market for Young Adults. I'm going to start by talking about how the stock market works, followed by explaining the ins and outs of two popular types of investments for beginners, ETFs, or exchange-traded funds, and mutual funds. And lastly, I will talk about the different means of actually investing money. So the stock market is a collection of companies that are publicly owned and traded. In the United States, there's slightly over 4,000 publicly traded companies at the moment. When you own a share of a company, you own a small portion of that company, but that does not mean you get to make any decisions on behalf of that company. Stock prices are constantly changing due to supply and demand. As a company is doing well, the stock of that company becomes more desirable, and thus demand rises, causing prices to rise. So mutual funds. Mutual funds are a collection of different stocks, bonds, and other assets that you buy into as one big group. These funds are managed by a professional or a group of professionals that trade individual assets into and out of the fund to maximize returns. Because of this, mutual funds are designed to be hands-off by the individual investor. Different types of mutual funds are designed for different purposes. For example, this graph on the slide is showing the risk of a target date fund. Target date funds are often used for retirement accounts and slowly get less and less risky as the target date, or retirement date in this case, approaches. Exchange-traded funds. Exchange-traded funds are very similar to mutual funds as they are a group of stocks and bonds that are managed as one by a professional. The biggest difference is the ETFs can be traded in the middle of a trading day, while mutual funds can only be traded after hours. Another difference between these two types of funds is that ETFs often have lower expense ratios. This is because most ETFs are based around indexes, which are a set group of stocks such as the S&P 500 index, which consists of the largest 500 publicly traded companies in the United States. Since there is little to no turnover, they take less time to manage and thus are cheaper. There are many different means of investing. A few of the more popular companies are Vanguard, Charles Schwab, Fidelity, Ally, and T. Rowe Price. All of these companies allow you to buy mutual funds and ETFs, but they all have different pros and cons. Some companies require a larger initial deposit, such as Vanguard, which often turns away young investors. These companies also have different funds with different goals and costs, and it is up to the individual investor to decide what is best for them in their situations. The difference in net worth at retirement is drastic for every year of adulthood that somebody waits to start investing. I hope you take these tips and information about mutual funds and ETFs and start investing as soon as possible. Thank you.